Welcome back, students who are taking financial accounting. In this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 8, the Group B exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And as a quick aside, we're dealing with assets, and with assets, you end up depreciating them. Okay, so we're talking about a higher level here. Okay, I mean, even though we're in financial accounting, it's one thing to say this is a piece of equipment. Okay, and how do you book it? And then you learned how to depreciate it. Well, now we're moving into intangible assets, natural resources, the buying of a business, that type of thing. So there's the theory behind depreciation, is covered in the theory videos in financial accounting and also in the math for business and finance. So I'm not going to be going over the methods of depreciating, which are equally applicable to amortization and depletion. What's more important now in these videos is that you understand the new concept that's being presented. And it just occurred to me, by the way, it's the same exact thing with statistics. If when you have business statistics, your education is cumulative. It's not linear. It's not like studying American history where you can study the American Revolution and then forget about it when you go move on to the Civil War. It doesn't work like that in statistics or accounting, right? What you do in one chapter applies to another chapter, okay? In statistics, in like chapter 3, you talk about standard deviation. But when you get to like chapter 7 or 8, when you talk about binomial distribution, the author already assumes that you know how to do standard deviation. So even though you're being given all of the data for that particular problem, he's not going back over and explaining how to do standard deviation before he moves on to the new concept that you're learning, which is binomial distribution. This is the same exact thing. I'm not going to be explaining how to do depreciation. I am moving on to explaining the concepts of goodwill, amortization, depletion, change in useful life, that type of thing. So with that said, next problem is 8-42, and this one is on goodwill. Dillon Corp aggressively acquired other companies. Assume that Dillon Corp purchases Simmons for $16 million in cash. The market value of Simmons' assets is $22 million and has liabilities in a market value of $8 million. Compute the cost of goodwill purchased by Dillon Corp. Record the purchase of Simmons by Dillon Corp. Okay, so compute the cost of goodwill. All right. So the purchase price is $16 million. Okay. The market value is $22 million. And it has liabilities of $8 million. So the market value of Simmons is $14 million. So the goodwill ends up being $2 million. Okay. So I'm just going to quickly go over it again and just point out that, here's the price that's paid, right? And you have to then look at the business in and of itself and say, okay, what is the value of the business? Remember, assets is equal to liabilities plus equity, okay? So we're saying the market value, right, which is an estimate, right? Goodwill is an estimate. The market value is 22 million, okay? But the market value of the liabilities is 8 million, okay? Now, generally, the market value of the liabilities is the actual value of the liabilities, right? But the market value of the assets is generally never exactly what it is on your books, on your balance sheet, for the simple reason, let's say you have an automobile, where you bought it for 48,000, you've depreciated 48,000, but you're still using it. Okay, so the books say that automobile has a value of 0, but really you're still using it, and if you went and sold it, you might get $3,000 more out of it. Okay, so that's why what we're talking about here being the market value. What is the fair market value of all of the assets, which is different from what is actually on the books. You could say the same thing about liabilities, but most often if you owe somebody something, that's exactly how much they want to get. So generally speaking, whatever you have on your books for liabilities is the amount of the market value of the liabilities. And of course, one from the other ends up being your equity, okay, or the market value of the business in and of itself. Okay, so this is a concept that you had way back in the beginning, right? So we look at the market value here, okay, and then we say, okay, this is what the market value is versus what was paid, and the difference between the two becomes our goodwill if it's if they're overpaying for the business, okay. And that happens all the time when businesses buy business. They're willing to pay the added value because it's down the road. They're expecting to make even more than that. Okay, they're not trying to nickel and dime a business to death. I mean, you're in business. People create businesses in order to make a profit, and they build that business with the intent of having the amount of goodwill as as the added value that they've gotten from that business. Okay, so that's that. Number one, that's how we calculate the goodwill. So now to record the purchase, let's see here. I'm going to erase it. Okay, to record the purchase, we have to get rid of all of our assets off our books. All right. And we have to record. All right, so we'll start out with the cash. We're receiving, remember where it says to record the purchase of Simons by Dillon Corp. So for Dillon, right, they're going to pay cash. So they're paying 16 million as a credit. Right. They're taking on the they're taking on the assets, right? And the assets are a debit because they're getting the assets, right? And that has a market value of 22 million. They're also taking on the liabilities, which is 8 million. Okay, and of course debits have to equal credits, so the difference has to be, and we're calling that goodwill, and that's going to be $2 million. Okay, so that's how we create our journal entry. Right. Notice what I did when I the thought process I went through in order to make this journal entry. Remember, we're looking from the perspective of Dillon. We're not, Simons is the company that's being sold. If they had, if on their books, if they have assets of 16 million, okay, well, for them, they're going to end up crediting their assets to get rid of the 16 million. but we're not making this journal entry, okay? We're making the journal entry from the perspective of Dylan, who's buying it. So when my thought process is okay, I start out with, for Dylan, what are they giving up? They're giving up their cash, okay, for 16 million, the purchase price, okay? Then number two, I record the assets at market value. Number three, I record the liabilities at market value. And then number four, just because debits, right? Debits have to equal credits, right? These have to equal, right? Then I can just back into the 2 million by just adding up the two and subtracting one from the other, okay? But we already did the calculation, so I can just, and you would already know that, because obviously there's a lot of accounting that has to be done on the sale of a business. So you would already know that the goodwill would be 2 million, and that's just, in making sure that your journal entry is correct. You just say, okay, I know that my goodwill is 2 million, but I have to make sure it's a debit, so that my debits equal my credits. This is 24 million and this is 24 million. Okay, so that's it for that particular problem. Let's see here. Let's see what's the next one, if I should go on. Payment of purchase of the minerals, payment of fees and other costs, depletion. All right, nope. I'm going to stop the video here and pick up with the next problem in the next video. But just remember that, again, if you didn't understand some concept here, go back and watch the theory videos, because I'm just skipping over. I'm not going into the in-depth explanation of it. So if you're missing something, go back and watch the theory videos in this chapter or in the Math for Business /application section. And if you still don't understand the concepts, then feel free to contact an instructor.